This is it tracks tech, obviously, as it says, modern platforms, digital marketplaces. So it tracks things like Twitter, eBay, but also the London Stock Exchange. So anything people are sort of moving across on the internet on. You're going to be overweight tech and communications, obviously. Let's look at the tail of the tape here. These aren't the best products to compare it to, but if you look something like ARK or FDN, you can see some similarities there. I think the non-US exposure here, you get more international in this one. And you're going to have the similar market cap weighted. So it's like one of these, but it's very different as well. Now, I want to introduce this new function, Drive Go, which just came out, which is perfect to use on this. It goes next level and shows you other things that the ETF is exposed to. So, for example, the stocks in this ETF are very much have positive sales surprises. That's a tailwind. That's good, obviously. A lot of cash, a lot of ROE, but you're going to be a lot of dispersion on what sell side thinks. That's a headwind. A lot of volatility. And the dividends, you get no dividends here. So this is going to show you the different ways to look at the ETF. So, but beyond that, as we all know, what's really going to jumpstart this is whether it performs well or not.
Of course, it always comes back to that. Now, still with us is Jeremy Schwartz, Global Head of Research at WisdomTree's. So, Jeremy, when I looked at the fund and what it contained, it seems like it was e-commerce, e-payments with some exchanges thrown in there for good measure?
I mean, it is really trying to be, if you think about how is business transforming, you hear a lot about this asset light where you don't own the production, you own the means of connection. And when you think about, as you guys gave in the lead, growth, how do you find growth? And all the smart beta factors that focus on value, and even WisdomTree got to start focusing on value. And we're saying, how do we get more growth exposure? Is there a business model that's changing the industry? And these platform models from Uber and Lyft and these asset light seems to be a growth story that you can get around. And they're growing earnings and sales. Like the sales is 3 to 4 times faster than the standard S&P 500 companies. And their margins, whereas the standard margin, gross margins are 30% on an S&P 500 company, these are in the 60s. So there's a really good business case that this is the future of a lot of business and that these are growing faster with better margins.
Still, it's a pretty distinct theme, and WisdomTree is not exactly a firm that's known to be a thematic ETF issuer. They have PLAT, they also have one that deals with cloud computing.
You have cloud computing, I can see a trend here. Now let's talk about this, because you come from the academic world, and you know quants and academics, they kind of look down on themes. They think they're gimmicky. Here you are coming out with them. Defend the value of a theme ETF.
And I go back to going beyond value. And so, you know, if you say growth, like how can you get at growth in different ways? In the tech space, software is a lot of the future of tech, and this cloud is really what's going after software. And so it was a unique opportunity to partner with Bessemer Venture Partners. They were creating an index. They're the premier venture capital firm focusing on the cloud space. They worked with NASDAQ Traded Index. We licensed that index. And you know, going beyond value, if there is this big long-term shift towards the cloud, we think that's just another great way to get exposure.
All right, let's go away from themes for a moment and go to geographies, because you're known for your Japan funds, specifically DXJ, which is your Japan hedged fund. What's the case for DXJ right now?
So a lot of people focus on the central banks and monetary policy.
Because they're a big owner of the ETF.
Look at that chart.
That's the big narrative, and it's that all the way around the world, from the ECB, the US. I just wrote a piece that Japan is the world's deepest value play. Now, they have dividend yields ahead of MSCI EAFE. If you go back 30 years, they've had a lower dividend than the broad international markets, much lower than the S&P. The dividends and buybacks have been increasing, so DXJ's average dividend yield is 3.5%. That's 50% more than the S&P 500. They're doing buybacks, so everybody says Japanification, we're worried about Japanification of the global economy. Japan is Americanizing. They're getting the buyback and dividend trend, the shareholder returns, at lower multiples than most of the international markets.
Yeah, but isn't that taking all the animal spirits and the reality out of the market?
They're trying to support, and this is like, you know, are the central banks chasing their own tail, where they started buying it to lower the equity risk premium, the market's safe, we're buying equities, and now they have to worry that, well, now people where they can't exit. How are they going to exit? We have a head of Japan, Jesper Kohl, who's talked about, well, if they just announced at the Ministry of Finance that they'll let people have an inheritance tax free to buy ETFs from the Bank of Japan, they would be able to sell those ETFs in a minute. And so now you have this battle between the Ministry of Finance and the Bank of Japan. They have to figure out, are they just going to hold these forever? How do they get people comfortable that it's not this overhang on the market? But they did it to support the equities, and now just people are worried about it.
So very quickly here, do you even think about the BOJ when you're looking at Japanese companies?
I think they should worry more about the fundamentals, that dividend yield, higher shareholder returns, cheapest valuations in the developed world. And yes, the Bank of Japan is supportive, but so is other central banks.